The 1920s were characterized by a pervasive sense of economic prosperity. This era fostered a widespread belief in continuous, boundless economic growth. Society held an optimistic outlook regarding the future of financial markets. The prevailing sentiment suggested that prosperity would endure indefinitely. This period reflected a strong confidence in the stability and expansion of the economy. The stock market recently experienced a period of rapid and significant growth. This upward trend attracted widespread attention from the general public. A diverse range of individuals, including shop owners, began to participate. Even taxi drivers, from various professions, were drawn into the investment activity. Many were eager to invest their capital, hoping to capitalize on the market's ascent. During periods of market optimism, individuals often engage in speculative financial behavior. This involves borrowing significant amounts of money to invest in the stock market. The primary motivation is the belief that stock prices will continue to rise indefinitely. This assumption drives increased leverage and investment in equity markets. Such actions are fueled by a prevailing sense of confidence in sustained market growth. This behavior can lead to market bubbles, as asset prices become detached from underlying value. This period, often perceived as a golden age, was built on an unstable economic foundation. A key characteristic was the significant increase in debt across various sectors. Speculative investments were rampant, contributing to market instability. An unchecked sense of optimism regarding future market performance fueled these conditions. In October 1929, the stock market began to show clear signs of instability. This period marked a significant shift in the prevailing economic conditions. Stock prices, which had previously been rising, initiated a consistent downward trend. This reversal indicated a critical turning point in the broader economic cycle. The instability signaled the onset of a major economic downturn. Market panic is a rapid, widespread decline in asset prices, driven by fear rather than fundamentals. It often begins with an initial drop in prices, triggering investor anxiety. This fear quickly propagates through the financial system, affecting many participants. Investors, fearing further losses, initiate a mass exodus, attempting to sell their holding. This surge in selling pressure overwhelms demand, causing prices to fall even more sharply. The cycle of selling and falling prices exacerbates the market decline, leading to widespread panic. A market collapse is triggered by an overwhelming volume of rapid selling activity. This intense selling pressure leads to a severe scarcity of willing buyers in the market. Consequently, market values plummet, resulting in the evaporation of billions of dollars. Such an event, occurring within days, signifies a profound and severe economic shock. A market crash represents a severe and rapid decline in asset prices across a significant market segment. Such an event often triggers a cascade of institutional failures, including bank collapses. The widespread financial distress leads to the closure of numerous businesses and job losses. These failures collectively exert a profound and detrimental impact on the broader economy. An economic downturn signifies a period of significant decline in economic activity. Such downturns frequently lead to widespread job losses across various sectors. Millions of individuals can lose their employment, resulting in a dramatic surge in unemployment rates. This unemployment surge causes severe financial hardship for affected individuals and families. The overall impact includes reduced consumer spending and a further contraction of the economy. Economic crises often lead to significant social consequences for affected populations. Families facing financial hardship are frequently compelled to seek public assistance. This reliance on aid is a direct result of the economic downturn's impact on household stability. Long queues for essential food supplies become a common sight, indicating widespread distress. Such scenes underscore the severe social and humanitarian challenges triggered by economic instability. A profound crisis led to widespread and devastating losses of personal assets across the population. Many individuals experienced the forfeiture of their homes, a fundamental pillar of security. Additionally, life savings, accumulated over years, were eradicated, causing severe financial hardship. These massive asset losses generated an overwhelming sense of insecurity among the populace. A deep feeling of despair permeated society as future prospects diminished significantly. Consequently, immediate survival became the paramount and singular concern for affected individuals. During a market downturn, a significant portion of the population often reacts with panic. This widespread panic frequently leads to impulsive decisions, such as selling investments. However, a smaller, distinct group of investors demonstrates a different response. This group maintains composure, refraining from selling their investments amidst the volatility. Their behavior contrasts sharply with the general market sentiment, highlighting divergent investment strategies. Strategic investors identify opportunities amidst widespread market panic. They recognize that market downturns often lead to undervalued assets. This approach involves acquiring assets, such as stocks and businesses. Real estate is also targeted, often available at significantly reduced prices. Such calm, calculated acquisitions aim for long-term financial gains. Financial crashes inherently facilitate a significant transfer of wealth within the economy. Individuals who react to market downturns with panic typically incur substantial financial losses. Conversely, those who maintain a long-term investment perspective can accumulate significant fortunes. This mechanism highlights how market volatility redistributes assets among different investor behaviors. Wealth transfer during economic crises is a recurring historical phenomenon. This pattern was evident during the 1929 economic downturn. Subsequent events, such as the 2008 financial crisis, also exhibited this dynamic. These instances demonstrate a consistent historical trend of wealth redistribution during crises. Historical patterns indicate the inevitability of future crises. Understanding these patterns is crucial for strategic planning. Preparedness is essential to navigate periods of instability. A patient approach to investment is key during turbulent times. This strategy aims to convert chaos into opportunity. It emphasizes avoiding panic and maintaining a long-term perspective.